Hello and welcome to News You Can Use, your weekly dose of making sense of personal finance headlines through the week and to see how they impact your money life. Okay, the first one I couldn't resist. Netflix loses 200,000 users, first drop in a decade. How does this impact your money life? Well, not much, I'm guessing, because you're probably one of those 100 million who are sharing the password according to Netflix. And in any case, in India, it's 200 rupees a month. So if you're sharing the password, it's 100 rupees. Hopefully not much impact on your money life. Okay, what's the second one? Sorry, that was, not a personal finance headline per se. The second one is, though, it's about Infosys' share, which fell 7% on one day. And this headline suggests that because of that, there could be further weakness in tech stocks. Now, there was another headlines which was talking about weakness in HDFC Bank. Again, both these companies, Infosys and HDFC Bank, came up with results that did not meet estimates. And the second headline seemed to suggest that other private sector stocks will do better than HDFC Bank. These headlines are good for traders whose investment horizon is like a few days or a few weeks, and these kind of drops can impact them quite substantially. However, you have to understand the Infosys stock, for example, has gone up like 2.5 times in the last 2 years. For long-term investors whose horizon is 5 years, 7 years, 10 years, they really need to focus more on the quality of the company, the overall business visibility, rather than quarterly results, 1 quarter, 2 quarter, 3 quarters, because those can be volatile because of corporate action or because of various reasons. But in the long run, what is the visibility, business earnings visibility for the company? That is more important for long-term investors. Keep that in mind. And if you're a long-term investor, then these kind of headlines are not relevant to you. Okay, the next one. Stock returns to trail earnings growth this year and the next. This is a headline from an interview done with a fund manager. These kind of interviews are actually very good for investors who are going direct into the stock markets. This fund manager is suggesting that valuations in the stock market are indeed high, and the rally of the last 2 years is suggestive of that anyway. And he's saying that now earnings growth are likely to see the uptick, but because stock markets have already performed well, maybe the returns from that stock are not going to match up the earnings growth, and which is okay, because you see, you've already got the gains when the earnings growth was not there. So this is it's interesting, and you must be aware of it. There's nothing you should do if you've got good quality stocks in your portfolio, but be aware of this view that the stock gains in a lot of cases have happened already in the broad market, and now is the time for earnings growth to catch up. So don't get too sort of disappointed if your stock returns are not matching what is happening in the company earnings itself. Okay, next one is not equity, it's about debt. Rich investors see Bharat Bond ETF as a way to beat fixed deposits. Bharat Bond ETF is a target maturity kind of fund from Edelweiss Mutual Fund. It is basically listed on stock exchanges where you can buy it. Now, target maturity means that it has specific maturity. There are different series out from 1 year maturity to 10-year maturity. And what's happening is inflation, and as a result, interest rates are going up and bond yields are going up. And when the yields go up, portfolios like this, which have a target maturity, which have a fixed maturity, you can actually benefit by buying and remaining invested till it matures. If you try and exit before, you could fall prey to the volatility and may get a return which is lower than expected. So get into these kind of schemes only if you have the intention of holding till the period of the scheme itself. And I don't know why the headline says rich investors. I feel like, if you have a good understanding of the product, then even if you're not rich, you can invest. However, yes, for those in the highest tax bracket, there is a tax advantage as well, because if you are in this for more than 3 years, you get an indexation benefit on your tax, which is like an added advantage. So maybe that's why it says rich investors. Okay. This one is not a new headline. Growing concerns on wholesale inflation, which is up 14.5% pressure on retail prices too. We have been talking inflation practically every episode, and it is really showing up out there up front right now. There's not much you can do about inflation because it is not in your control. What you can do is be mindful of your long-term investments. Make sure that they are in growth assets that can beat inflation, because that is the only way to grow your wealth in the long run. Around your expenses, which is what inflation will impact now today, is your daily expenses, because fuel prices have skyrocketed, and that can trickle down to pretty much everything from the biscuits you buy to the vegetables you buy. Start monitoring where are the costs going up, and then start rationalizing, cutting back if you need to. If you find that your savings are actually getting impacted and this is affecting your monthly cash flows, then you need to start budgeting and cutting back. That is the only thing to do while inflation is headed upwards. Okay, the next one is about India's economic growth. IMF cuts FY23 growth forecast to 8.2% from 9%. And for the next year, this is the headline, and the table shows that for the next year, IMF is talking about a 6.9% growth, which is even lower than the 8.2%. That means there is some expectation that the economy is not going to do as well in the next 2 years. Now, this can become a worry if it starts impacting the job market, and which means that earnings for individuals can slow down. I'm not an economist, I'm not an expert, but if these predictions and estimates do come true and the job market does start getting hurt, then your cash flows will suffer, your earnings will suffer. I would say the way to look at this headline is not to get worried or anything like that, but keep this in your head that globally there are things happening. There's talks of global recession as well, and slowdown in growth in India could impact your earnings, could impact your investment earnings as well. So this is not a year to go around splurging your money. This is not a year to do all that revenge shopping and revenge travel. This is a year to save up till there is clarity, certainty, till there is a positive move on economic growth, till there are signs that yes, we are going upwards and not downwards. So I think just keep it in mind and be aware. Okay, curated portfolios can generate better returns, but mind the risk. This is an article about small case portfolios and how they are doing well, and how there are specific fund managers who have given like more than 100% return in a year. It's very tempting. Seems to suggest that this is the place to be in, and these are the portfolios to chase after. But what are the risks that they are talking about? So the risk, firstly, is the fund manager risk itself. Just because a portfolio has performed 100% in 1 year doesn't mean that the performance will be repeated every year. If that was the case, then all of us would be investing only in these portfolios, but it does not happen like that. If you notice, most of these portfolios are in the small cap space, and that has done well in the last couple of years, and maybe that's showing up in the returns. But the risk is very much there in small caps. Over a period of 10 years, the premium that you get from small cap investing is perhaps about 2% over a large cap kind of fund. So it is not that different. This is what historical data tells us. Also, if you notice, one of these schemes, it's talking about a fund manager who selects like 6 stocks which are less than ₹100. So, what is the criteria of selection? Are you really sure that this is, not just some kind of, just putting your eggs in the baskets that look attractive and not really knowing what's in that basket actually that makes it attractive? That's another risk. Then there's the risk of cost. The cost is, it's like, I think, 1,000 rupees a month, or slightly less than that, maybe in some cases. It adds up. So what is your portfolio size versus that kind of cost? So that also you have to keep in mind. The risk of concentration is there. So don't put all your money in it. If you want to try it out, start small. So all those things are there. I think what you need to focus on really is go back and ask more questions. What is the consistency of performance of these portfolios? How long have they been in existence? How have they performed across different market cycles? When the market cycle changes, is there consistency of return, or do the returns go up and down along with markets? All these are questions to be asked from the fund manager rather than blindly chasing return. Okay, another headline like this: most stocks in which HNIs raised holdings beat indices. You don't see headlines which say most stocks in which HNIs invested sort of dragged behind indices, because then that would mean that you're better off investing in the market index itself, but you don't see headlines like that. And how do they know that these are most of the stocks that HNIs invested in? How do you know how many stocks HNIs invest in and what proportion of their portfolio is this? Yes, these are stocks which did well, but does it mean that HNIs don't invest in stocks which don't do well? Very, very misleading headlines. It makes you want to own what these people owned and where they made money, but it is very likely that you'll end up buying these stocks and make no money and not know what happened, and then end up selling at a loss and never come back to equity market. So don't follow these kind of headlines. Stick to your tried and tested equity portfolio. Stick to your method. If you want to invest directly in stocks, then do your research. Don't follow somebody else's. Okay, that's it from me. Thank you for listening, and I look forward to doing this again next week.